Good morning, 201ers, or good afternoon, or good night, wherever you are. I wanted to talk about your assignment. Since it's due Thursday, I want you to have plenty of time and some knowledge about what's going on. So first, as a reminder, let's talk about how making loan payments has kind of a different impact on bottom line profitability than we might think. So if we buy an asset that is, we'll just say that it's a new tractor, that entry is to debit the tractor and to either credit cash for $100,000, so that's my offsetting account, or and to credit note payable tractor for $100,000. Either one of these two offsets what's going on here when we add the tractor to the balance sheet. So remember that the balance sheet is just looking at assets and liabilities, and then what's left over is owner's equity. So if we just think about, so I have my assets, and over here I have my liabilities, and then the leftover is owner's equity. If I'm buying with cash, I have plus $100,000 and minus $100,000. And over here, my remainder of owner's equity is unchanged because I'm just changing things. And one way to think about that, and forget about depreciation at this point, is that if I'm exchanging a tractor for cash, it would be like taking $20 bills and getting two $10 bills for each $20 bill. It's not going to have any impact on owner's equity. Okay? Now, if we don't do anything with that tractor, if it just sits, we're going to have interest expense for owning the tractor. One of two reasons we're going to have interest expense. Number one, we would have interest expense if we borrowed the money, and the interest expense is explicit, we know what it is. Or number two, if we used cash, that $100,000 isn't earning interest any longer, so we have an expense just through ownership. So the cash flow implications, if we're looking at are we financing the tractor or are we paying for the tractor, don't have the same implications as for profit as they do for cash flow. So let's say that the terms of this $100,000 loan are $10 years at 5% annual interest. So this means that in year one, I'm going to pay $5,000 of interest because I carried the full value of the loan, the $100,000 for an entire year. I'm only making payments at the end of the year. So the first year's payment is going to have $5,000 of interest. But each payment, if it's equally amortized, is going to be the same, meaning that the amount of principal that we pay, the first payment, is less than it is going forward. And one way that we can easily figure this out is by using an amortization table that you have in the back of the book. And the first one is amortization factors for equal total payments. And that is the standard loan practice that you will see a bank having. So for my terms, 10 years and 5% APR, my amortization factor is 0.1295 times the loan amount, $100,000. That's equal to $12,950. So over the course of the loan, if we multiply that by 10, because we're going to make 10 payments, we're going to make payments totaling $129,500 to purchase a tractor that costs $100,000. You might say, why would I give someone $30,000 to use their money? Because you don't have the money, and hopefully the tractor is increasing profits and revenue enough to cover for this interest expense and also the depreciation that goes along with it. So if I look at ownership of the tractor and I say, you know what, it's got a useful life that's equal to 20 years. And the salvage value, this is not really of 0. We're just going to depreciate the whole amount. My depreciation expense each year is $5,000 if we're utilizing straight line depreciation. And my average interest expense is somewhere in the ballpark of $2,500. And the way that I got $2,500 so quickly is the average value of the asset is $50,000. And so from beginning to end, if we're saying, hey, the cost is 5%, whether it's an explicit cost that is going to matter when it comes to cash flow, but here we're looking at profits. Now I have to say there's some interest expense even after I pay it off, because if I pay it off and it still has $50,000 of value, then I have $50,000 that isn't earning any interest that I could sell. The used market for tractors is very liquid. I could sell it at the end of 10 years, put that $50,000 back in a bank account and earn interest. So we're estimating that it's $2,500. So I have $7,500 of expenses every year that go along with the tractor. Okay? Plus, I have some operating expenses that go along with it, and we'll just say that they're $5,000. So in total, each year, my expenses are going to be $12,500. Keep in mind, these aren't cash expenses necessarily. This interest expense is a cash expense for a while, but then it is no longer. The depreciation expense is never a cash expense, except for when you buy it, and really even then, when does that expense realize itself? To me, I think about the tractor's value is derived from the fact that it's just prepaid depreciation. You have a $100,000 asset that's going to depreciate down to 0. You're just paying for the depreciation expense up front. But since I'm using it for 20 years, I want to know what's the impact on profit each and every year. Because once it's paid for, that doesn't mean that it's free to use. It doesn't mean that depreciation expense is gone. It doesn't mean that interest expense is gone. And it certainly doesn't mean that my operating expenses are gone. So I've got this $12,500 of an increase to expenses. And I think that my revenue every year is going to increase $16,000, less my expenses of $12,500, which means that my profit each year is going to be positively impacted by the amount of $3,500. So this investment analysis that we're looking at here, we're looking at a change to profits. And we're saying that investing in this piece of capital, the tractor, the planter, upgrading facilities, whatever it is, it's going to increase my profits by $3,500. But nowhere here are we being very precise about cash flow, because we're looking at the useful life is 20 years. And for 20 years, my revenue increasing by $16,000 is probably not a sure thing, but that's something that's going to be positive every year, and it will be a cash inflow. But my cash outflows are all over the place. So if we look at this from a standpoint of what's happening from year 0 to year 20. Well, from year 0 to year 10, so year 1, 2, 3, 4, 5, 6, 7, 8, 9, I have minus $12,950 every single year. That's cash outflow. And every single year I have that, and that $12,950 includes that interest expense that we were talking about. And in addition to that, I have $5,000 of cash outflow, those operating expenses. They're going to continue on. And in fact, they're going to continue on as long as I'm still putting fuel into the vehicle. Okay? From a standpoint of how much is this increasing my cash inflow, I think we said $16,000. I'd have to rewind. Going to be plus $16,000 for every year all the way to year 20. The impact to cash between year 0 and year 10, 16,000 minus 12,950 minus 5,000 is negative $1,950 every year for the first 10 years. So even though my profit is going up by $3,500 each year, my cash flow is going down by $1,950 for the first 10 years of the asset's useful life. But remember that cash flow doesn't exactly equate to profits until we can somehow balance all of this out. Balance is probably a poor word. Remember that when I'm making this $12,950 payment each year, what that looks like is I have note payable, and maybe that's going down. It's going to be different every year, so we'll do it for the first year. For the first year, the balance is going to go down $7,950. Well, how do I know it's $7,950? Well, remember that the loan amount was $100,000 at 5%. So 5% of that is $5,000. And if I make equal payments of $12,950 that we got from our amortization table, at the end of the 10th year, that last payment will pay for exactly the accrued interest and the principal balance that's left over. So my note payable decreases by $7,950. I incur an interest expense of $5,000. And my cash balance goes down by $12,950. So we can look at this and hopefully have a full understanding of how this negative cash flow, while it's not a good thing, it makes the investment perhaps not feasible. If you don't have the cash to do it, you can't make the investment. But what we have to remember is if we take this part out, we are profitable. If you think about the fact that, hey, my interest expense is $5,000 and I have $5,000 of operating expenses, and we can't forget about depreciation. I have $5,000 of depreciation expense, 5, 5, and 5. I have an increase to profit in year 1 of $1,000. And that's the year that I'm going to have the most interest expense. So even in year 1, I have profits. And in year 2, it's going to be greater. And in year 3, greater. And year 4, greater. Because my interest expense amount is going to go down each and every year. Where this will rectify is after year 10, this $12,950 goes away. So if I'm looking at year 11, year 12, year 13, year 14, year 15, need more space there. In year 11, I still have my increase in revenue of $16,000. I don't have this cash outflow any longer. All I have left are my operating expenses, in which case I have $11,000 of positive cash inflow. Now, does that mean I have $11,000 of profit? No, because we still have the $5,000 of depreciation expense, and we have a small amount of implicit interest expense, but we're going to be left with $5,000, $6,000, $7,000 of profit. So because we're having to pay back the loan, that has negative implications on cash flow at the beginning of the loan, but very positive cash flow implications after the loan is gone. It's very, very hard to look at this loan payment and say, gosh, you've got a note payable that's going down $7,950. You have an interest expense that's $5,000, and you have cash that's going down $12,950 and say, how is that not having a nearly $13,000 negative impact on profit? It's not. Because what's happening is when you think about the balance sheet, I'm being relinquished from $7,900 of debt. It's like having $20 in your pocket that you owe to someone else. Yeah, you got $20 in your pocket, but if you owe someone $20, it might as well not be there. So this is just we relinquish a liability, or we relinquish an asset to be forgiven part of the liability. The only part that is truly an expense is the interest expense. That's the cost of having it. That's the cost of using it. We wouldn't own it if we didn't plan on using it. What is true is the negative implication to cash flow. And that's what we're talking about when it comes to financial feasibility. Okay, this should help you out with numbers 1 through 5. If you have any individual questions, certainly let me know.